Hi friends, welcome to the channel JIV and CIV Made Simple. So this is in this particular lecture we are going to discuss our theory of unit number 6 of ABFM, and the chapter name is controlling. So let's see what are the topic which we have to go through. So first of all we will see the basics of controlling. We will understand that the basics of controlling, how it works. Then we will see characteristics of controlling. We will see the advantages of controlling, limitation of controlling, types of control management, control process, relationship between planning and control, and control technique and information technology. For those of you who are looking for videos in English, I want to tell you that we have complete lecture available in English for your understanding purpose, which will help you in understanding the concept in a very lucid manner. So if you are interested to get our English lecture, you can WhatsApp me on this particular number. Let me write down the number, right? So that if you want such lecture which is available on our app, so you can WhatsApp me on this particular number to get more detail. So let's start the session without wasting any time. So the first topic we have to study is the basics of controlling, right? So have you ever wondered how top companies stay on the track, meet their goal and fix problem before they get too big? The secret lies in controlling, right? This is the final and the most crucial steps of management, right? So we have been discussing the step: planning, staffing, directing, controlling. This is the final step, right? This is the final step of management. So the secret lies in controlling. Let's break it down in the simplest way possible. So basics of controlling, that is what we are going to talk about. What is controlling? Think of it like Google Map for business. You can think of them like a Google Map for business, right? Just as a GPS guides you, controlling makes sure a company move in the right direction, right? It makes sure that company move in the right direction, right? It checks if the goal are being met and taking corrective action if something goes off the track. If corrective action are not taken or not, means goals are being met or not, right? And if not met, then corrective action should be taken. So how does it work? So let's talk about. First of all, first page is planning. Planning means deciding where you want to go. Second is organizing, means arranging resource. The third is staffing and directing. So staffing and directing means assigning the right people. And the last is controlling. So control means what? Control means keep an eye on progress and make changes if needed, right? So these are the four steps: planning, organizing, staffing and directing, right? So planning, what the planning means? Planning means decide where you want to go. Organizing means arrange resources. Staffing and directing means you assign the right people. That is what I mean by saying staffing and directing. And finally you control. Control means keep an eye on the progress and make change if needed. Now the question is, why is this important? So we know what are included in this. Now the question is why controlling is important. You know that it helps business stay on the track, right? So here is the point: aligning with the organization goal means it helps business stay on the track, right? If something is not going as planned, so if the something is not going as planned, controlling identify the issue, right? Identify the deviation, identify the issues. When I say deviation, I mean to say issue. So identify any issue and fix it, right? So identify any issue and fix it. It ensures that company does not waste resource, company maintain quality and expand smoothly. So this is very important, that if there is any deviation from the plan, if something is not going as per plan, so controlling identify the issue and fixes it. It ensures that company does not waste resource, maintain quality and expand smoothly. Now let's talk about the characteristics of controlling. So here we are, characteristics of controlling. You know, controlling is the superpower of a well managed business. What is controlling? This is the superpower. Of well managed business, right? So the why it is called superpower, let's understand. What are the characteristics? The first characteristic is goal oriented. You can see goal oriented. It means that it keeps the organization focused on achieving its target. Imagine a cricket team without a scoreboard. How would they know if they are winning, right? So this is like a scoreboard, right? Just like cricket team, there is a scoreboard, they know they are winning or not. Now second thing is efficient resource use. You can see efficient resource use. It means it ensures that money, time and manpower are not wasted. No unnecessary expense is equal to higher profit. Obviously no unnecessary expense. So if there is no unnecessary expense, it clearly means higher profit. That means profit will be higher, right? Okay, the third point is that it ensures it boosts employee motivation, right? It boosts employee motivation. What it means, that when there is a clear system, employee feel more confident, perform better. So clearly it means, if the employee are happy, if happy employee are there, it means our company is productive, right? So that is the point. Now it error detection and future planning. So you know that it detects the error. What it means, that controlling identify mistake before they become disaster and help improve future strategy. Think of it like a teacher correcting your mistake so that you can score better next time. So controlling is not just about keeping an eye, it is the backbone of a successful organization, right? Whether it is reducing waste, improving quality, or growing the customer base, controlling plays a key role, right? So I hope this make your concept clear. Now let's discuss the advantage of this so-called controlling. What are the advantages of controlling? Let's discuss it now. So friends, imagine running a business without control, like driving a car without brake. Suppose it's just like driving a car and this car have no brake, right? So that is what controlling, running a business without control. Sound risky, right? That is why controlling is must in management. It is what keep a company efficient, disciplined, as well as successful. Let's break down its biggest advantage in the simplest way possible. So question is, why is controlling important? What are the advantages of controlling? So first of all, it helps the business to achieve the goal. You can see accomplishing organization goal. So achieve the goal. So think of it like a Google map for the business. I told you earlier, you can think controlling like a Google map for a business. That just like GPS keep you on the right road, similarly controlling ensures that all the company activities are aligned with its goal. No detours, no unnecessary stop, just a clear path to success. Now the second advantage is that it maintains errors. It fixes the problem, right? Which means mistake happens, but controlling catches them early before they turn into a disaster. So before a mistake turn into the disaster, what controlling does? Controlling identify it, controlling catches them. It is like having an autocorrect feature in business. So spot the error, fix it, and move forward, right? The third point is the smart use of resource, or we call it effective use of resource. You know what it is? Controlling makes sure that the money, material, and manpower are used wisely. So it means that if there is no wastage, it means what? It clearly means that more profit. No wastage, it means profit will increase, or profit will be higher, and higher efficiency. So this is what is ensured by efficient use of resource, or we call it effective use of resource, or smart use of resource. Then the next point, it's accuracy and quality, right? It validates accuracy, it ensures accuracy. What if a company set the wrong standards? So it may happen that a company set the wrong standards. What if the company set the wrong standards? Controlling check and correct them, making sure everything is done the right way. It is like a quality control for the success. That is why it is called validate accuracy of standards. What if the company take a wrong standard? So it validate it. Now the next point, it maintain a structured and discipline, order and discipline, right? You can see it improves order and discipline. It maintains discipline. So a well structured system boosts motivation. When employees know what is expected and see clear goal, they work better. I told you earlier that happy employee means productive company. Then the next important point of controlling, as you can see here, is that better coordination and teamwork. So you can see better coordination and teamwork. So here it is. That imagine a cricket team where everyone plays their own way. It will be chaos, right? It will be chaos. When everyone plays their own way, it will be chaotic. So controlling ensures a smooth coordination. So let me write down the key point. Controlling ensures a smooth coordination. Right? So that all departments work in a sync, right? Like a well-trained team. Now it makes supervision easy and distribute work efficiently. So the next advantage is it makes supervision easier, right? Manager don't have to micromanage everything. With clear control in place, work can be delegated smoothly and decision making can be decentralized. This is super important thing. Let me talk about it. So I think this was the point. Here it is. Here you can see simplify supervision and decentralization. That with clear control, the decision making can be decentralized. This is one of the effective feature. This is one of the main feature of this so-called controlling, right? That is decentralization of the decision making. It makes operation faster and effective. And finally, it provides insight for future planning, right? You can see it provides feedback or insight for the future planning. What it means, controlling acts like a company report card. So this controlling acts like a company report card, right? So it tells management what worked, what did not work, and how to plan better for the future. So a smart decision today is equal to bigger success tomorrow. So controlling is not just about checking things, it is what keep a business running smoothly, efficiently and successfully. Whether it is achieving goal, reducing mistake or planning for the future, controlling plays a major role. I hope this helped you understand. If it helped, don't forget to like, share and subscribe for more CIB exam insight. So that is the advantages of the controlling we have just come to know, but there are limitations also. Let's talk about it. So friends, controlling is like a security system. Controlling is like a security system. It is like a security system for business. It keeps things on track, fixes error, ensures smooth operation. But wait, is it perfect? Not really. Just like any system, it has its limitation and different way of working. In this slide, we are breaking it down in the simplest, most interesting way so that you can understand it for both exam and real life. Stay tuned. First of all, let's talk about limitation of criminal. Why it's not perfect? So first thing is that it is costly, it is expensive, right? So setting up a strong control system costs money, especially for a small business, right? Especially for a small business. So it is like buying high-tech security camera, great protection, but costly. Obviously, cost is a matter here. Now, the second point is that hard to measure non-quantifiable factor. There is something called non-quantifiable standards or non-quantifiable factors. So it is hard to measure these non-quantifiable factors. So that not everything can be measured in number, right? And not everything can be quantified. It is most expensive. That is the first point. Second thing is that it is hard to measure non-quantifiable factor. So what it means? It means that not everything can be measured in number. So how do you quantify employee motivation? Can you quantify the motivation of employee? Tell me, let me know. Can you quantify the motivation of employee? No. How can you quantify the creativity? How can you quantify the customer satisfaction? So motivation, creativity, customer satisfaction, these factors cannot be quantified. So this make comparison tough, right? So you cannot measure non-quantifiable factor. That is why comparison becomes tough. Now the third point is that no control over external factor. You can see no control over external factor. Even the best business plan can't control government policies, consumer behavior, changing customer preference, new technology or tough competition. Sometimes you just have to adapt it, right? Sometimes you just have to adapt it. Even the best business plan can't control government policy. So limits or no control over external factor. This is one of the major limitation. And there's something called employee resistance. Means what? Employee may resist. Imagine being watched all the time. Would not that feel restricting? Employee often see control as a loss of freedom, right? What happened? Employees see the control as a loss of freedom, right? So leading to frustration. And then we have the next point, that is over reliance on control or over dependence on control. You know what it means? If manager depends too much on control system, they may stop actively supervising. They may not actively supervise, right? That is the point. If the manager depend too much on control system, they may stop actively supervising. It is like relying on autopilot too much, great for a while but risky if things goes wrong. That is called over dependence on control. And the next point you have that it can slow down work. So too many rules and approval, if we add too many rules, if we add too many approval, so obviously it will cause the delay, right? It will obviously cause the delay, right? So overly rigid control can make decision making slower and less efficient. And last but not the least is the point that wrong control can cause problem. If a company set the wrong type of control, it can lead to error, fraud or major operational failure. Now let's talk about the types of control management. So now we know what are the advantages, what are the major disadvantages of it. So let's talk about the types of control management. The first types of control management is, it can divide into three types. The first is called feedback control. So feedback control means after the activity. So we can write it after the activity. So think of it like a movie review. You watch the movie first, you analyze what worked and what did not work. Business do the same. They evaluate past action and improve for the future. So that is called feedback control. The second kind of control is called proactive control. You know what it means? Before the activity, right? Suppose this is the activity. So if we control before the activity, it is called proactive. If we do something outside after the activity, it is called feedback control, right? So proactive control means what? This is like checking the weather before planning a trip. Business anticipate problem in advance and take corrective action before issue arise. And there is something called concurrent control. Concurrent control means what? During the activity. So during the activity, this is what we call as concurrent control. What it means, that imagine playing a video game. You adjust your movies in real time based on the situation. This type of control happen when the work is in progress. So this is called WIP, work in progress. Understood? So this concurrent control of occur when there is work in progress, right? Making instant correction. You make the correction instantly, right? Now let's talk about the control process. So basically how it all works, right? The control process we are talking about, how it works, that is what we are going to discuss now. So basically what we are going to discuss is how this control process works, right? So let's discuss it now, how it works. So control is not just about finding mistake, it is about ensuring every action aligning with the company goal. So on one side we have action, and on one side we have goal, right? So you have to ensure that every action aligning with the goal, right? So manager constantly check performance, make decision and adjust plan to keep everything on track. So while controlling is super useful, it is not flawless. Yes, controlling is super useful, right? Because we have to align our activity with the goal. Controlling is super useful, but it is not flawless, right? I hope this this help you clear the concept. Now let's talk about the basic elements of the step to control. Let's talk about it. So imagine running a business without control, right? Employees don't doing what they want. Employees are doing what they want, right? And no targets, no performance check, right? It would be chaos. That is why controlling is crucial. It helps business stay on track, avoid mistake and achieve goal efficiently. So we will break down the control process into simple real life example to make it crystal clear for your upcoming CIV examination. So first step is selecting goals and standards. So first of all, what you do, you select your goal, you select your standard. That is the basic process, right? So why it matters? Because it would be have you ever played a game without knowing the rules? It is impossible, right? So the same goes for business. They need clear goal so that everyone know what to achieve and how to measure success. So this goal is very much important, right? Now for example, a sales team may have a goal to sell 1000 units in a month. So a sales team may have a goal to sell 1000 units in a month. A company may set a standard for excellent customer service, right? But how do you measure that? So what we learned from this discussion is that clear goal, if you have clear goal, it means clear direction. It means clear direction, right? So without them, a business is like a ship without a captain, right? So this is called clear communication of goal, standards and objective. Now the second point is that what we need to do, comparing actual performance with the goal, versus goal, right? So you have to compare the actual performance to the goal. This is the second step. This is the point. What it means, that now the goals are set. How do we check progress? So manager track and measure performance using, so sometimes they can use the sales number. Did we hit our 1000 unit target? They can use customer feedback, right? They can use customer feedback. They can use sales target. They can use customer feedback, right? Are the customer happy? They can use a financial expert. Are we making a profit? So these kind of question they ask. So did we hit the sales target? This is monetary terms. Are the customer happy? These are the customer feedback. Or what did the financial expert say? Are we making a profit? So now the question is, what if a performance don't match expectation? So your performance, so you have set a goal, right? You have performed, but your performance did not match the expectation. Then what? So that if target are not met, manager must figure out what went wrong. Was it poor strategy, market condition or lack of effort? So what we learned, just like tracking your weight loss progress after setting a gym goal, business must constantly check result and analyze gaps. Now the step 3 is to take the corrective action, right? The third step is to take the corrective action. So we are talking about the steps involved in the controlling process. Step 3 is to take corrective action. That what if things goes off track? What if things goes off track? That the company need to act fast to fix the issue. So there are two ways they can fix the issue. The first is called default fix. Simple predefined solution like offering discount if sale drop. So predefined solution, that we will offer discount when the sales drop. And the second is called a specialized plan, right? So the second is called specialized plan, or you can say specialized plan. This is the second. So it means that complex problem need custom strategy. So if we have a complex problem, we need custom strategy, right? Like hiring consultant to improve performance. Imagine a car manufacturing company finds a quality defect. They won't just ignore it. They recall the car, they fix the issue, they ensure that it does not happen again. That is corrective action, right? So what we learned is spot the problem, fix it, and prevent the future issue, right? And that is how business stay on the top of their game, by setting clear goal, tracking performance, fixing issue. They ensure success. Simple, right? So I hope this helped you. Please hit the like, subscribe, and stay tuned for more CIV insight. Now let's talk about the control process. Taking corrective action, we just talk to know. Right, default fix, specialized plan. Default fix, what they do, they ready-made solution for common problem, right? And specialized plan means customized strategy for major issue. Custom strategy and default fixes are ready-made policy, right? For example, if a factory machine break, they here hire expert to fix it as soon as possible. Then we have monitoring the corrective action, that how did the fix work, right? So this is the next point, that did the fix really work. So I think it is repeated. Okay, I think it is repeated. Just okay, yes, yeah, here it is. So the next step is to monitor, did the fix work. Fixing the issue is just the first step. Manager must keep an eye on the result to ensure that the issue is actually solved or not, right? So what was the issue? Whatever was the issue, was it actually solved? Is it actually solved, right? Future mistakes are prevented by learning from the past error. For example, if a restaurant faces bad review due to poor service, just hiring more staff is not enough. They need to check if the customer satisfaction improve or not, right? So how do they know that whether this fix work or not? So they, through evaluation and comparison of the measure, these are the important thing, right? So these are the important things through which they come to know. So what is the key takeaway from this discussion is that first of all you fix it, then you monitor it, and then you improve. So these are the three steps: fix, monitor, improve. That is how business stays successful. And then we have planning and control in action. So why are these connected? Relationship between planning and control, let's talk about it. So question is, how are planning and control connected? So why are they connected? So you can think of planning as the map and control as the GPS. So you can think the planning as the map, this is a kind of map, and this control as the GPS, right? So think of planning of a map and control as a GPS. You plan your journey, but without control you might take wrong turns, obviously. So how do they work together? So planning set the goal, right? So planning, what is your objective? That is planning set goals, right? And means what should be achieved. And control, what it does, control check progress. Control check progress means are we on the track? If we go off track, corrective action brings us back. So what we learned, that planning without control is just wishful thinking, and control without planning, it is just following a GPS without a destination, right? So I hope this is clear, that what is the correlation between planning and control. So planning is the objective setting is done through planning, and controlling ensures that they are met. Controlling monitors any deviation and take corrective action. Planning provides the foundation for control process. That is what it is all about, right? So I hope this make your concept clear, that what is the planning and what is controlling and how they are correlated. Now let's talk about the next point, that we have, I think we have covered this thing. Yeah, this thing we have covered. Now future orientation of planning and control, this is the key point, which is very important. So friends, ever wondered how successful business stay ahead in the game? It is not just luck, it is the planning for the future and keeping things under control. Let's break this down into simple terms. So the topic you can see is the future orientation of planning and control. So why are both future focused? Planning is like setting a goal post. It is all about deciding what needs to be done in the future to succeed. And controlling is like a coach adjusting the game strategy. So controlling, you can think like a coach who is adjusting the business strategy, right? Even if you have a plan, things may go wrong. So control help you course correct. For example, imagine you are starting a new business. You plan everything, product, marketing, team, budget, everything you have planned. But what if sales drop? That is where controlling help. It spots the issue, it make adjustment to keep you on track, right? So you plan everything, you plan your product, you plan your marketing, you plan your team, you plan your budget, but what if the sales drop? Then where controlling comes into picture. So what we learn is that a business without future planning is like a ship without a compass, but without control, even the best plan can fail, right? So that is how you can see that controlling is so much important. Now what are the control technique, right? So what are the control technique which are available to us? Let's discuss now. Here we are, control technique. So question is, how, when I talk about control technique, what I mean to say, that how business keep track, right? So manager needs the right tool to monitor progress. Think of control technique as a business thermometer. So when I talk about control technique, you can think of like a business thermometer. Business thermometer. So think of the control technique as a business thermometer. They check the health of an organization. And control method should be relevant. The first key point is it should be relevant. Relevant means it means that different level of management need different data, right? So do you have different level of management and they need different data. The second point is that it should be strategic. Relevant, it should be a strategic. Let me write it down. So what is the meaning of a strategic? A strategic means the method must suit the company size, customer and challenges, right? So they should suit the level, department or operation. So for example, a small business may rely on personal observation. So suppose, let me give an example. Suppose we have a small business, so it may rely on personal observation, right? But a large organization may use some data analytics. Suppose it is a large organization, so it may use some data analytics, it may use some AI tools to track performance. So that is what it is all about. So that is what I mean to say, that control technique means how business keep track of it, right? So control method should be relevant, it should be strategic, right? That is what we are talking about here. So relevant, I have told you here, I have told just in the meaning of relevant. Relevant means different level of management need different data. And if we talk about strategic, it means the method must suit the company size, it must suit the company client, it must suit the company challenges, right? This is meaning of a strategic. So two key things must remember, that control method should be relevant and strategic. So relevant means like different level of management, different data. Like a small business rely on personal observation, while a big business rely on a data analysis and tool. So depending on what kind of client you have, what kind of business you have, whether it is small business, whether it is larger business, that is how control technique vary with respect to the business relevancy as well as the strategicness, right? I hope this is clear. Now let's talk about some traditional control technique. What are they? Old but gold. Old but gold method. This is something called old but gold, right? So that is called traditional technique. So what are they? The first is the personal observation. This is the first technique. This is called personal observation. This means the oldest and simplest method. Manager personally check a work progress to ensure things running smoothly. Question is why it is still needed. That even with the technology, nothing beats direct supervision. That is called direct observation. So let's see the advantages of having direct observation. This is nothing beats it. A manager walking through a factory or bank supervisor observing a staff still make a huge difference. So what we learned, that old school technique still work because sometimes seeing is believing. This phrase, I think you know it very well. That's called on-spot observation. You know it very well, that seeing is believing, right? So what do you think? Should I obviously now then we have something called the direct observation. So what is the meaning of this so-called direct observation? So have you ever noticed how a business manager keep an eye on employee, on how company project profit, right, predict profit? It is all the part of control technique. Let's break it down in simplest term. So when you talk about the direct observation, it just means that we keep a close watch. It just means that we keep a close watch. What is the meaning of it? The manager personally observes employee at work, right? So manager personally observes employee at work, right? And think of it like a cricket coach watching player during practice to guide them instantly. So the question is, why is it effective? Why is it effective? That employees stay alert and motivated. The first key point is that the ultimate advantage of having the direct observation is that employees are motivated, employees stay alert and motivated. So they are motivated, they are alert, right? So no one wants to slack off when the boss is watching, right? That is the point. The second point is that immediate action, right? So the second point is immediate action, which means that if something is wrong, manager fix it on the spot. So that is why this direct observation is so important. The third thing is that better communication, right? So communication is better, which means that employee can raise issue directly instead of waiting for formal meeting, and it boosts morale, which means when employee feels seen, they work better. And key takeaway is that supervision is not just about control, it is about improvement, right? That is called improvement. So supervision is not just about control, it's called improvement. The second thing we have is the break-even analysis. This is another control technique, right? Knowing when you start making profit. So what it is, it is a profit calculator. We can call this break-even analysis just like a profit calci. Calci, profit calculator. It shows when a business start covering cost and moves into profit. So how does it work? Let's understand. So this is also called cost, volume and profit analysis, CVP analysis, right? So the formula of break even is nothing but fixed cost divided by price minus variable cost. Fixed cost divided by price minus variable cost. This is the formula, right? So, so how to remember it? Quite easy to understand. Let me give you some example to substantiate it. So you see this pie chart. So I think if there is space, let me draw a bigger pie chart so that the concept become crystal clear in your mind. You need not remember any kind of formula. I hope this space is sufficient to do that. So you think of this pie chart, right? Okay. This is your complete sales. This is your complete sales, right? What we do, we divide this pie chart into two parts. The one part is variable cost and the rest part is called fixed cost. Okay, this fixed cost has two parts. This fixed cost has two parts. One part, one part is the fixed cost and the other part is your so-called contribution, right? Or we call it, the one part is contribution and other profit part is your profit, or EBIT we call it, profit. Now at break even what happened? Our profit is zero. Our profit is zero, right? So break even point means that amount, that number of unit for which profit is zero. Now tell me, if profit is equal to zero, so what it be? Our total contribution will, so what will be the equation? So we can say that basically what happened, that this variable this is variable cost. Fixed cost has two part, right? So I think I have written the reverse. This is fixed cost. So suppose n is the break even point. Suppose n is the break even point, and this is what we call contribution per unit, right? So contribution is what? Sales minus variable cost is called contribution, right? So the formula for break even point is fixed cost divided by selling price minus variable cost. So selling price minus variable cost, quite simple to understand it is, right? So what you do, so this fixed cost is always not calculated per unit basis. Suppose n is the that number, so n multiplied by SP, sales price, minus variable cost, this will give you fixed cost, right? So when this happen, when break even happen, this entire fixed cost is equal to contribution, right? So this entire fixed cost, so we can say that this entire fixed cost is equal to contribution. Whenever break even will happen, there is no profit there, so entire fixed cost will be our contribution, right? And what is contribution? So contribution is n multiplied by contribution per unit, right? And what is contribution per unit? It is nothing but total sales minus variable cost. So we can say that n is equal to FC upon sale minus VC. That is the formula written here. So this is how we derive this formula for break even point. So for the time being, I have just given you the derivation of the formula. No need to derive it, just remember this formula. For example, let's say if a bakery has rupees 50,000 in fixed cost, okay, and earn rupees 50 per cake, okay, with rupees 30 as the variable cost, okay. How to find the break even point? So per cake it earns rupees 50 and variable cost is rupees 30, right? So what you can show it graphically also. So basically what is happening, that this is our 50,000, this is our 30, this is our 50, right? Per unit. So you just multiply it by n, so we can write n times 80, or n times 50 minus 30, right? N times 20 is equal to 50,000. So n is equal to 50,000 divided by 20. So this will give you how much? 2,500 cakes. So it means that if this much cake is produced, the seller will neither be at profit nor be at loss. It is the break even point, right? So why it is useful? Because it predicts how much you need to sell before making profit, right? So this is called by break even point, and it help in precision decision, right? It help in pricing decision. Okay, so so if cost rise, should you increase your profit or not? It guides business growth. It help avoid losses by adjusting cost and sales target. So what we learned from this break-even analysis is that before making profit, a business first cover its cost. Then we have something called a statistical report. This is another control technique. Right. First we have discussed is the direct observation. Then we have discussed the break-even point. The third is the statistical control. So what is the meaning of so-called statistical control? Let's talk about it. So what are they? Manager collect numerical data. Right. Manager gather information, or we call it numerical data. So manager collect numerical data like sales, like profit, right, or market trend. So manager collect this data and analyze it using chart, graph and table. Right. So they use something called chart, graph and table to analyze it. So the question is, why is it important? You know that basically quick decision making. This is one of the important part. Quick decision making, which means that number highlight problem area, visual clarity, easy to understand chart versus long report. Obviously this is easier. And performance tracking. For example, a bank track loan repayment rate. If default increases, the bank adjusts interest rate to minimize the risk. So what we learned, number don't lie. A good statistical report help business stay ahead. So, and that is how business stay efficient with direct observation, profit tracking and data analysis. These are the three techniques which I have just talked now. Then we have something called budgetary control. So this is another control technique, you know, right? So ever wondered how business stay within budget and avoid financial chaos? So that is where budgetary control comes into picture. So basically what I mean to say is budgetary controlling is that planning and monitoring finance. You know, budgetary control is like setting financial boundary. It is like setting financial boundary. It is like you are setting financial boundary, right? So for a company, just like we plan our monthly expense at home. Now question is, how does it work? So first step, what you do, you break company goal into a smaller target for each department. Right. So first of all, you subdivide company goal into a smaller target. Then you compare actual performance versus predefined planned budget. And if there is a gap, you take action. Let me give you an example to make it more clear. These steps. Imagine that a bank plan to lend rupees 500 crore. Suppose a bank plan to lend rupees 500 crore in home loan this year. Right. If by mid-year only rupees 200 crore, if only rupees 200 crore are lent, they revise a strategy that what they do, they lower the interest rate, right? They and do the better promotion. So why is it important? Because it helps track progress and control cost. It ensures money is used wisely. It helps in day-to-day financial management. So what we learned till now, that budgeting is not just about planning. It is about constant monitoring and correction. That is what we know about. Now, if we talk about the types of budget, you know there are different types of budget. Let's talk about it. There is something called cash budget, which means manages cash inflow, cash outflow. Think of it like company bank balance tracker. Then we have something called sales budget. What is sales budget? It means that estimate how much revenue the company expect, like setting a sales target for a year. Then we have production budget, which means plan how many products should be made based on the demand. So there should be no wastage. There should be no shortage. And capital budget, you know, for big project like opening new branches or buying asset. And then we have something called material budget, which means ensuring enough raw material for production. So what we learned, that different budget ensure the smooth financing planning across all area. Now let's talk about the modern technique we have. You know, a smarter way to control operation is the modern technique. With changing business need, modern control technique help manager make better data driven decision. So what is new? The first is something called advanced analytics. Advanced data analytics, right? Advanced data analytics for better prediction, AI automation to track real-time performance. Now, for example, you know, a bank use AI based software to track customer spending and predict loan default before they happen. So that is how budgeting keep business financially healthy. Now there is something called return on investment. Let's talk about it. Ever wondered how business measures success just beyond just sell? That is where return on investment comes into picture. You know, ROI, that is called return on investment. It tells us how much profit a business make from the money it invests. See, this is a business, right? So it invests money, right? It invests money. So after investing, how much profit it is making, right? So what is the formula? It is a report card. It's just like a report card for investment. It is also called DuPont method. Both are the same. You must remember it, right? What is the formula of ROI? So the formula of ROI is that net income upon sales multiplied by sales upon total investment. So two things you have to multiply. on one side you have to write sales in denominator, on the other side you have to write sales in numerator, and net income is your of overall profit, how much you are generating, and your sales, and the second point you can see is your investment, right? So but wait, what does this actually means? For example, let me give an example. For example, imagine a bank invests rupees 10 crore, right, in a new digital banking platform. If this generate 2 crore in the net income, so ROI help measure if the investment was worth it or not. So how can ROI be improved? So either you increase the sale without drastically increasing investment. So there you can see there are two ratios. The first is income upon sale, right? So if you increase sale volume more than the overall investment, or another is sale upon investment. So you see this ratio. If you increase this sale value and this increase later, so overall this ratio will increase, and that is why our ROI will increase. This is one way. Another thing is that you look at the first ratio. What is the first ratio? It is income upon sale, right? So one more way, one income you cannot control. What you can control is this investment. This investment you can control. So your overall monitoring factors will be this: sale upon total investment. So this thing you can control, right? So what you can do, you increase your sale, right? You increase your sale by this much, and you increase your investment by this much. So overall ratio will increase. And the second way is to increase our ROI is to reduce investment. You reduce it while keeping sales steady, right? So you know it very well that ROI is inversely proportional to our investment. If our sales remain constant, so if investment decreases, so our ROI will increase. So these two ways you can increase our ROI. So by looking at this particular ratio, mathematically you can tell this thing, that if you increase sale by drastic amount and your total investment increase by a small amount, overall your ROI will increase, obviously. And the second thing is, if you decrease your investment, your ROI will increase provided sales remain constant, right? So key takeaway is that a company goal is to get maximum profit from the money invested. So why is this ROI important, right? The ROI is important because it helps company check financial health. It ensures investment bring good return. It attracts investor by providing the business is profitable. Think of it like this way: if two bank invest rupees 5 crore in new ATM, so suppose this is bank 1 and this is bank 2. This invests 5 crore, this also invests 5 crore in new ATM. But one bank earn more from it, so that means they manage their investment better, right? So then we have something called key financial management technique. Let's discuss it. So what are the key financial management technique? You know that financial management and ratio analysis. Why? To understand profit, liquidity and financial health, right? So if you want to understand profit, liquidity and financial health, so we have something called financial statement and ratio analysis. We calculate various ratios, right? So how do we do it? So by using some common ratio. So why we understand, why do we use this so-called financial management and ratio analysis? How do we do it? So we do it using analyzing profitability, liquidity, solvency and turnover. You know about these ratios. For example, a bank check its loan recovery ratio to see how will it collect loan. And now there is something called responsibility accounting. You know what is the meaning of this so-called responsibility accounting? Let's cover it now. Let's discuss it now. So friends, big organizations have multiple departments and each department is responsible for different tasks. Employees are held accountable for their financial performance. Now, there are 4 responsibility centers are there. The first is called, you must know it, the first is called revenue center, which means focuses on generating income. Second is called cost center. Revenue center, cost center. What is cost center? Which means control expense. Cost center, control expense. Revenue center, it focus on generating income. Then profit center, you know it very well, it balance income and cost. And investment center, it manage capital and return. These are the 4 types of centers. So what we learned, that financial management technique help track, improve and compare performance across department, right? I hope so. So what we learned, that ROI is not just a number, it is a powerful tool for financial success. Now PART and CPM we will talk in the next lecture. So let's end our first part here. So what we have learned in today's session, just give you a brief overview. So you can see that we have seen, just wait a minute. Yeah, we have seen basis of controlling, characteristics of controlling, advantage and limitation, type of control management, right? Presently we are in control technique. This we are covering, and this is the largest topic, right? So we will cover everything rest in the upcoming lecture.